Cool. Let's get this started.
Let's do it.
All right. Hey, guys. My name's Cyrus Wilseni. I'm actually chair of YPN, and this is Danny. She's vice chair.
Hi, everyone. How are you? Good morning. We're happy to have you here today.
Super exciting.
Yeah, so we are really excited. We have Carol Quan. She has 34 years of experience with the LA County Office of the Assessor. I also want to applaud everybody on here right now. I know we're, in different times, especially with us all being quarantined, but I really appreciate everyone being on here and continuing, their education to better serve your clients and just be the best realtors, and, helpers to realtors that you can be. So, like Brenton had said earlier, any questions that you have, please feel free to type those inside of the Q&A section at the bottom of your screen. We are going to be doing a live Q&A with Carol at the end, so stay tuned for that. And anything else that I need to say before we get going with Carol, guys?
We're stoked. We're stoked to have you guys on here. Like Danny said, it's a great thing for you guys to be logging on and just bettering yourselves as realtors and continuing your education. So with that being said, Carol, go ahead and take it away.
Wow, great. Good morning, everyone. This is really exciting. It's very different. I think this is my second online presentation, and I'm still trying to get used to it. But I'm just really honored to be able to share information from the Office of Assessor Jeffrey Pang and to provide as much information to realtors so that they can help their clients make informed decisions as well. So let's get started. California is under a law known as Proposition 13, and this was a law that was passed back in 1978. So as a result of that, the general levy is 1% of the property's assessed value. And then once we establish a base value, that assessed value for tax purposes increases no more than 2% a year. And so that's why you probably see a lot of properties that will have what we call a 75 base year value, and the assessed value could be maybe about 100,000 or so. Sometimes I've seen even less, but today's fair market value for that property would be over $800,000. And so for folks who owned property at the time Prop 13 passed, they've been able to anticipate what taxes are, and they've been able to keep their home because they're able to not be basically dinged with the assessments going up based on market. So the assessed value increases just to a 2% annually. It's not based on market every year. There's 4 events that can cause a reappraisal, and one is when there's a change in ownership, or when construction is completed, or when new construction is partially completed on the lien date January 1, or when there's been a decline in value. And a decline in value is when the assessed value as of January 1 is greater than the fair market. And in that situation, we would grant a temporary reduction that's good for 1 year, and then the following year we would automatically review it. And then when the market has returned, we will restore the full trended Prop 13 value. So a decline in value, it's temporary, it's not a permanent reduction. When we do make a reassessment, whether it's due to a transfer or due to new construction completion, it typically generates supplemental property tax bills, and supplemental bills are just one-time catch-up bills. It's billing for the difference between what is there on January 1 and what the new base will be, or what the new base is. And so the supplemental bill is sent directly to the property owner. If you have clients who have impound accounts, the supplemental bill is not sent to the lender. It is the responsibility of the property owner to pay the supplemental bill. Now, if there is an impound account involved, the homeowner, the property owner, can always speak with their lender and ask if there's sufficient funds in their escrow account that could help them pay for the supplemental property taxes. But it is a bill that goes directly to the property owner. Now, depending on when a document is recorded, if it's in the first half of the year, it'll generate 2 supplemental bills because you're within 2 tax years. If you're in the second half of the year, you just receive one supplemental bill. Tax years are based on a fiscal year. It's July 1 through June 30th. So if we record a document, let's say March 1st of 2020, the property owner at the end of the year will receive 2 supplemental bills in addition to the annual property tax bill. And so that's why if you closed some deals already earlier this year, you may get a phone call from a panicked homeowner around October, November, because they received notification of 3 bills, or they would have already received their bills, and they could have sticker shock, and they're going, wait, didn't we take care of everything in escrow? Why am I getting all these bills? And the reason they're getting the 2 supplemental bills is because they closed in the first half of the year. They were still within the 2019-2020 tax year. And then the second would be for all of the 2020-2021 tax year. And so just calm them down. And you know what? We have a great feature on our website I'll show later. It's a supplemental estimator. And so going back, if you record, let's say August 5th, you just get 1 supplemental bill, and that would be prorated from September 1 of 2020 to June 30th of 2021. This is a picture of our home page, and on the home page, we've added features that we think will be very helpful for those in the real estate professionals. You can see on the menu, there's home, homeowners, business owners, and real estate professionals. And those are drop-down menus. And so within the real estate professionals drop-down menu, we have the tax estimator. We also have it under the drop-down menu for the homeowners, as well as, I don't have the full screen, but on our most popular section from the homepage, there's also another direct link to the supplemental estimator. But also under the real estate professionals drop-down menu, we have tidbits of information that we hope you will read up on, and feel free to clip and paste on your e-newsletters to your clients. And it's just information on some various tax, like Prop 13 or tax savings programs. And so it'd be very helpful for you and also for your clients. So this is the supplemental tax estimator, and all we would need is a street address or the assessor identification number. You click enter, and then once you get to the next page, you put in the recording date and the purchase price, click enter again, and it will let you know what the estimated supplemental taxes will be, whether or not you're going to get 2 supplemental bills or 1 supplemental bill. And then on the reverse side, let's say your assessed value as of January 1 was $1 million, but the fair market that the property sold for was about, let's say, $500,000. So when you go to that estimator, instead of getting information on supplemental taxes that are due, you'll see what the estimated negative supplemental is, and that would be basically a refund. And the thing of it is that when there's a negative supplemental, the annual property taxes still have to be paid on the higher assessed value as of January 1. But the supplemental check or the negative supplemental will make up for that difference. Let's go into some of the exemptions, exclusions, and tax relief programs that we administer. So the most basic exemption for a property owner or for a homeowner is the homeowner's exemption. If you own your home, it's your primary residence, you can go ahead and file for the homeowner's exemption. It reduces your taxable assessment by $7,000. So you save about $70 a year off your annual property tax bill. The filing deadline is February 15th. If you've just recently acquired a property, we will automatically send you that claim form. Just go ahead and file it as soon as you receive it. And if it's received within the deadline, then you will still be able to receive the homeowner's exemption for that year. If you are looking at your annual property tax bill, because people do ask, well, how do I know if I have the homeowner's exemption? So go pull out a copy of your annual property tax bill, and right above the perforation for the second installment step, they'll have information on land, improvement, total assessment, less exemptions. And so if you see the number 7,000, less exemptions or less HAWK 7,000, That means you have the homeowner's exemption. We also have that information on our website, assessor.lacounty.gov, and you would just pull up your property profile from our website and look at the assessment history, and you'll be able to see if you have a homeowner's exemption on your property. There's also the disabled veterans exemption, and this is for our disabled vets who are blind in both eyes, they've lost the use of 2 or more limbs, they're totally disabled as a result of injury or illness incurred in military service. They must be rated 100% disabled by the Veterans Administration, and the filing deadline for the disabled veterans exemption is February 15th. They can qualify for 90% if they file by December 10th. And backtracking to the homeowner's exemption, if you missed the February 15th deadline, as long as you file by December 10th of the year, you can receive a partial homeowner's exemption for that year. It'll be 80%. And then the following year, you'll receive the full $7,000 homeowner's exemption. So the schedule for the disabled veterans exemption for 2020, the basic disabled veterans exemption is $143,273. The low income disabled veterans exemption is $214,910. But to qualify for the low income, their household income cannot exceed, $64,337. And so for the disabled vet who qualifies and receives this, they can save anywhere from $1,400 to $2,100 a year off their annual property taxes. And like the homeowner's exemption and the disabled veterans exemption, the basic exemption, it stays on and it's adjusted annually. So the homeowner's exemption, once you file, you don't have to file again. The basic disabled veterans exemption, once they receive it, they don't have to refile every year. It's adjusted every year based on inflation. Now, if the disabled vet received a low income exemption, they would have to file every year because they need to report their annual income to us to see if they still qualify for that. If they don't qualify for low income anymore, then they will automatically default to the basic disabled veterans exemption, so they don't lose out on it. The next one is the parent-child exclusion, and this is a provision that will allow transfers between parents and children. It can go parent to child or from child to parent. So those transfers can be excluded from reassessment, because remember earlier in the slides, I said that whenever property changes ownership, it is subject to reassessment. It's a reappraisable event. And in this situation, it is a change in ownership, but it may be excluded from reassessment. The property must be owned by either the parent or the child. Interest in a legal entity like an LLC will not qualify. Interest in their revocable living trust would qualify. There is a limit of $1 million per eligible transferor, but the primary residence will not count against that million, and the million is based on the assessed value of the property as of the date of change. And so if let's say the parent owns 2 properties, the primary residence and maybe a commercial property, and gives everything to the child would need to file a parent-child exclusion form for each property. Now, let's say the commercial property is currently assessed at $600,000. So that is below the $1 million, and that property would be excluded from reassessment, and so the child can continue paying taxes based on the $600,000 going up 2% every year. The primary residence would be excluded, and the value of the primary residence will not count against the million. So let's say the primary residence is currently assessed at $200,000. That $200,000 will not count against that $1 million limit. And so that's why it's really important, if there's several properties, that if one is the primary residence, that it have the homeowner's exemption or disabled veterans exemption on it. It would make life easier for everyone all around. Otherwise, we will count the value of the primary residence against the million because we don't know. And then the child or the interested parties would have to notify us that no, don't count it because this is the primary even though it doesn't have the homeowner's exemption, then you would need to provide us copies like a DMV registration or income tax returns and the like to prove that that property was indeed the principal residence. So just to make your life easier for everyone, if you qualify for the homeowner's exemption, have that exemption on there. For this provision, the claim must be filed within 3 years of the date of change or before sale to a third party. A claim may still qualify if it's filed within 6 months of the mailing date of the notice of supplemental or escape assessment. And for this provision, a child may be the son, daughter, son-in-law, daughter-in-law, stepchild while that step-parent-stepchild relationship exists, or a child adopted before the age of 18. There's also the grandparent-grandchild exclusion known as Prop 193. This is one way only. It can only go from the grandparent to the grandchild. But in order for the grandchild to qualify for that exclusion, the parent who is a child of the grandparent must be deceased. So that means if my mom wants to pass property to my daughter, her granddaughter, and for a granddaughter to file for that grandparent-grandchild exclusion, both my husband and I must be deceased. I know it's a little morbid, but let's say my husband and I are legally divorced, and then I pass away. Now my mom, maternal side, my mom can pass property to my daughter, and daughter can file for the grandparent-grandchild exclusion because we were legally divorced before I passed away. Or let's say I passed away first, and my husband doesn't remarry. He is still considered my mother's child. But if he subsequently remarries after I've passed away, he will no longer be considered her child, and now grandma can pass property to grandchild, and grandchild can go ahead and file for the grandparent-grandchild exclusion. Same filing deadlines as Prop 58. It's 3 years from the date of change or before sale to a third party. And again, a claim may still qualify if it's filed within 6 months of the mailing date of the notice of supplemental or escape assessment. Now, what many people don't realize is that death is a change in ownership. And so under the California Code of Regulations, it states in part that inheritance by will or intestate succession shall be the date of death of decedent. And so when a property owner dies, the assessor is supposed to be notified by the responsible parties, and we're notified by the filing of a changed ownership statement, death of real property owner. And that is the requirement under Revenue and Taxation Code Section 480B. And the form is supposed to be filed with our office within 150 days of the passing of the decedent, or if the estate is probated, then they can file at the time they do the inventory and appraisal. And the properties, even if it's in a trust, we still need to be notified. And that's where the children, and more often than not, the parents who have a trust and will name one of their children to be the trustee or the successor trustee of their trust. And so we get calls and emails on this every week. And what happens is that the parents have died, property's in the trust, we're never notified, and then the child sells the property within a year or two, and they think everything's fine. And later on, within a few months after they've sold it, what will happen is that they're going to receive an unsecured bill. The unsecured bill is due to the reassessment as of the date of death of the parent, and depending on when they sell it, determines how many bills they'll get. So if they sold it a year early, a year after, they'll probably just get the supplemental bill and possibly a prorated portion of the adjusted annual bill for the following year. And so that's why it's really important to notify the assessor's office. And so these are the documents that we require so that we can update our records. And that would be that change in ownership statement, death of real property owner, copy of the death certificate, a copy of the entire trust, including amendments, and the Proposition 58-193 claim form, the parent-child exclusion form. So all of that can be sent as a package to the assessor's office. I have a story I'd like to share, and this is a case where the parent had died, children stayed in the house, the property was in the trust. We were never notified. 10 years go by, the children decide, you know, we're gonna refinance in the house, take some cash out and fix it up. So when they did the refinance, that is when we discovered that the last parent had died 10 years earlier. There was no change in ownership form on file. There was no parent-child exclusion form on file. We reassessed the property as of the date of death of the parent. And because we were never notified, we can bill and collect for 8 years of back taxes. So the children, fortunately, they still live in the house. The mailing address, all the notices were going there. So they received a notice of supplemental assessment and a notice of proposed escape assessment. They received 4 set of bills totaling $28,000. It was $7,000 for each year the property escaped paying taxes on the higher assessment. And then another month later, they received another set of 4 bills for about another $28,000. So in total, they received 8 bills for escape taxes because they did not notify our office timely and because they did not file for the parent-child exclusion. Now, fortunately, they contacted our office after they received the first set of bills, and we explained that, well, even though the property stayed in your parents' trust all these years, the children were the beneficiaries, they were the owners, and death is a change in ownership, even if the property remains in the decedent's trust. And so they were still within the 6 months from the mailing date of the notice of supplemental assessment. So I told them the forms we needed. They sent us the trust agreement. They sent us the Prop 58 document. Everything was in-house by the 5th month or so. Don't have it in transit on the last day of the 6th month. It must be in-house within 6 months of the mailing date of the notice. I told them it's going to take us several months to review and process the claim, and in the meantime, they had to pay the taxes, and so they had to fork out $56,000. But happy ending, we approved the claim, reversed the date of death reassessment. Because they got the paperwork in within 6 months, it was retroactive to the date of death. They were refunded back all the taxes that they had paid, less about $600 because they were still benefiting from their parents' homeowners exemption all those years. So they don't qualify for that. So they didn't get back about $600,000, but they got back over $55,000 in taxes. Now, let's say they waited until month 8 to give us the paperwork, we still would have approved it. We still would have approved the claim, but it would not be retroactive. It would be prospective only. So it would be valid from the year they filed going forward. They would have lost out on over $50,000 in refunds because they filed late. And so that's why you as realtors, we depend on you to share this information. You know, I don't give legal advice. I know you don't give legal advice, but please direct them to our website, assessor.lacounty.gov, and go to the homeowners section and look at the exclusions and tax savings programs and read up on parent-child exclusion, date of death and all that, because you know it's a complicated process, and when people are dealing with a loss, you know that property taxes are not the first thing on their mind, but it is really important that they're aware of this. And so if you're working with a client who is selling a house that they had just recently inherited from a parent, it never hurts to say, hey, you know, have you checked out with the assessor's office? You know, there's a parent-child exclusion. And you know, if they have an attorney assisting them, then I mean that's fine. Hopefully their attorney is giving them that information as well. But realtors are basically like the first line of information for these future sellers and future buyers. And so it's just so important that you're able to share this information with them. Okay, another very popular or important provision is the senior replacement dwelling benefit known as 60 and 90. And under this provision, a senior is someone 55 years or older. They sell their primary residence and acquire a replacement residence of equal or lesser value within 2 years of the sale of the original. And they submit the claim form within 3 years of the acquisition of the replacement. If they meet all the statutory guidelines or requirements, then we can approve their claim and transfer their trended Prop 13 value from the original to their replacement. And I mean, this is a huge tax savings for seniors. I've seen some cases where a senior sold their original property for almost $10 million. They bought a replacement for $5 million. It took us about 9 months or maybe a little more to do the full review. We have thousands of applications, and so it does take some time, but in the end, the claim was approved and we were able to transfer their trended Prop 13 to their $5 million home. And I believe that their trended Prop 13 base was about $500,000. So instead of paying taxes based on $5 million, which would be over $60,000 a year, they're paying taxes based on $500,000, which is about, how much is that? $500,000. Is it about over $6,000 a year in property taxes? So this is a huge tax savings for our seniors. Yeah, this is a huge tax savings for our seniors. But I always caution that they need to do their due diligence. They need to know what the requirements are, and they need to be able to make sure they meet those requirements. The claimant must be 55 years of age at the time they sell the original. The replacement must be acquired within 2 years of the sale of the original. It can be 2 years before, 2 years after. The fair market value of the replacement must be equal or less than the market value of the original property. And so those are just very black and white. It's a one-time only benefit. Once you've used it, you cannot use it again based on age. And so equal or lesser, again, 100% or less of the original market value if the replacement was purchased newly constructed before the sale of the original, or it's 105% or less of the original if it was purchased or newly constructed within the first year, or 110% or less if the replacement was purchased or newly constructed within the second year. There's only 10 counties in the state of California that have what we call a Prop 90 ordinance in place, and that means those counties will accept the trended base from any county. And there's 6 in Southern California, 4 in Northern California. We've got Ventura, Los Angeles, Orange, San Diego, Riverside, and San Bernardino. And then in Northern California, we have Alameda, San Mateo, Santa Clara, and Tuolumne. And it's critical that before you sell and buy outside of the county you reside in, that you contact that assessor's office to make sure they have a Prop 90 ordinance in place. Counties can opt into the program, they can opt out of the program. And so, you know, you can buy there, but if they don't have a Prop 90 ordinance in place, they're not going to take your base value. And you'll be paying property taxes based on the fair market value at your new location. And so that's why again, it is critical to do the due diligence and to do the homework. And if you're assisting someone who is buying a replacement property and you see that this person is 54 years of age, 11 months and 25 days, and they're just about to record the sale of their original, what are you, I mean, I know you don't give legal advice, but you can tell them that, look, if you're selling and you're looking to buy the replacement, you need to wait till you're 55 years of age. Otherwise, the original, you're not going to qualify for that base value transfer. So it's very black and white, very black and white. And if you owned a duplex and you sell that duplex for $1 million, do you have the full $1 million to work with when you're looking for the replacement? And the answer is no. You will only have the value attributed to the unit that you occupied as your primary residence, or to the unit that qualified for the homeowner's exemption. And so if it's a 50-50 split, then you only have $500,000 to work with when you're looking for a replacement. And again, that's this information is on our website, assessor.lacounty.gov. Okay, last thing I'll cover is the disabled resident exclusion, known as 110. So under this provision, a claimant who's severely and permanently disabled may transfer their trended base from an existing home to a replacement home. And it's the same requirements as 6090. You must sell the original, you must acquire a replacement or complete construction of the replacement within 2 years of the sale of the original. There is no age requirement. And you may qualify even if you took advantage of 6090, and we do require a physician's certificate of disability. So that means that at the time the seniors took advantage of 6090, neither of them were disabled. They were whole and healthy, but maybe subsequently, maybe a few years down the line, someone becomes very ill, maybe ends up in a wheelchair, the house isn't working out for them. Let's say they bought a 2-story townhome. Now someone's in a wheelchair, it's not working out for them. They can sell that 2-story townhome, buy a replacement of equal or lesser value within 2 years of the sale of the original, and if they meet all the requirements and they submit the 110 claim form along with the physician's certificate of disability, and they meet all the other requirements, they can actually transfer the base value a second time. But if you take advantage of 110 first, because there's no age requirement, you could be 50 years old and take advantage of 110. When you turn 55, you will not be able to take advantage of 6090. So it doesn't work both ways. If you do 6090 first, you may be able to take advantage of 110 later, but if you do 110 first, you cannot take advantage of 6090 later. So the resources, again, assessor.lacounty.gov, as well as the Board of Equalization's website, boe.ca.gov. My phone number, the office number here, is 213-974-3101. So if you have any questions and you want to reach me, just give me a call, ask for Carol. Let me give you my email address. It's cquan@assessor.lacounty.gov. cquan, okay, cquan@assessor.lacounty.gov. So I'm open for questions if anyone has any.
Hey, Carol. Yeah, there's a number of questions in here, so let's start from the top here.
Okay.
A couple people have asked, is there a difference between LA and Orange County?
Property tax law is the same throughout the state of California. Now, if anything, there might be a difference in filing deadlines for a decline in value and also maybe for the assessment appeals. But in terms of property tax law, it is the same for all counties.
Awesome. That's great. Okay. And then we have a couple, let's see, there's another question here, and it says, on new construction, we are now seeing special tax assessments that used to be called Mello-Roos. I've been told these assessments are permanent versus Mello-Roos that were termed 20 to 30 years. Do you know anything about that?
I'm not too familiar with that, but when I've talked to the agencies that administer the Mello-Roos or a community facilities district, typically, you know, they're correct. It was about maybe 25, 35 years, but maybe some of them have the ability to renew. And so I don't know if that means that it's permanent, but it's just that they have the opportunity to renew that that assessment or that benefit assessment. So the best person to contact would be the agency, and it usually shows up on the property tax bill. I don't know if it would say Melrose, it might say CFD, Community Facilities District. So contact that agency and ask them for information or at least a link to the document regarding that particular direct assessment.
Okay.
Awesome. Thank you so much. So our next question that we have here, is there any chance of adjusting that homeowner's exemption for inflation?
You know, that was established way back in the 70s and it was never adjusted for inflation. It has, they have talked about it in Sacramento, but, you know, someone thought, why don't we raise it to like 27,000? And so that would save, you know, a little bit more than just the $70 a year. But the thing is that with the homeowner's exemption, the counties are reimbursed by the state for the homeowner's exemption. And so they would have to have funds to do that. And then there's also other issues, other programs that help property owners or help renters. So there's that renters credit as well. So that might be affected, but there has been talk about trying to increase that homeowner's exemption and adjust it for inflation, but it really hasn't gone anywhere.
Okay, great. Good information. Thank you so much. Another one we have is unmarried widow of a veteran exemption. Does the deceased veteran have to have a 100% disability rating?
So if the deceased veteran, so the veteran, he was disabled, and let's say he was 90% by the VA. So the VA had him rated at 90% and then he passes away. The surviving widow can go ahead and file for the disabled veterans exemption and provide documentation from the VA. And we would review, and if warranted, we would be able to grant the disabled veterans exemption to the surviving spouse of the deceased disabled veteran. Staff would have to review it, so I can't really say yes, 100% sure we're going to give it to the surviving widow, but she should go ahead and file for that. She or he should go ahead and file for the disabled veterans exemption anyways.
Awesome, thank you. And then another one is for parent to child exemption. Is it covered when the parent dies?
Yes, so a change in ownership can be a sale, it can be a gift, or it could be an inheritance. And the ones that we see quite a bit of these days is the parents dying and leaving property to their children. And so that was in that example I gave regarding the child who lived in the home and did a refi 10 years later, and that's when we discovered that the parents had died. So the parents can pass property to their child while they're alive. They can do it as a sale. The child can, buy out the parent, or the parent can just gift it over to their child, or they pass away and leave it to their child. But again, maybe before they do anything like that, they might want to consult with their CPA or estate planner, because I'm only looking at the property tax component. There could be other issues with IRS, capital gains, gift taxes, and all that. So before they do anything, they should consult with their accountant, their CPA.
Okay, awesome. Thank you. And then
that's a really good thing to note to everyone out there, is it's really important for us to stay educated, but when it comes to actual tax advice, please, please, please leave that to the tax professionals. So I just wanted to plug that in there again.
That's a good point, Danielle.
Yeah. We can all do our best to explain as best as possible, but when it comes to, things like that, we should definitely leave it to the people who have their, degree in that.
Yeah, I always say stay in my own lane,
Yeah.
So Carol, if a child is on a portion of the property, what portion is excluded?
Are you saying, let's say, mom and daughter are on title to the property, right? But it depends on who acquired the property originally. We have cases where the parents bought property together. So mom and dad buy the property, dad dies, mom's on title by herself. Mom then transfers property to mom and daughter as joint tenants because mom's scared that if something happens, she doesn't want daughter to go through probate. And so if she dies, then the property goes to the daughter, no probate. So even though the daughter's on title as the joint tenant, once mom passes away, the daughter still needs to file for the parenthood exclusion. Otherwise, we'll reassess it 100% because mom is the original owner. Daughter was just added on. Daughter is not the original owner of the property. If mother and daughter bought property together as joint and held it as joint tenants, then if mom passes away, daughter would still need to file for the parenthood exclusion. Otherwise, there would be a 50% reassessment. Or if mother and daughter bought property together and daughter passes away, then mom would need to file parenthood exclusion. Otherwise, it would undergo a 50% reassessment. Does that answer the question?
Yeah, I think that was actually a fantastic answer. Thank you.
Okay.
Can you please explain again what is negative supplemental tax, and then when does this happen and how is it calculated?
Okay. During the recession, we had a lot of situations where folks had bought property at the height of the market. Let's say they bought property in 2006, 2007, and they paid $1 million for their home. When the market tanked and the properties were selling, they weren't selling for the $1 million. They were selling for $800,000, $700,000. And so taxes are still based on the value as of lien date. When property changes ownership, we establish a new base value. And so let's say on lien date, it's assessed at $1 million, but the fair market upon sale was, say, $700,000. That's a $300,000 difference. So we calculate the same way we would calculate supplemental taxes, but it would just be a negative. And so 300,000 times 0.0125. Let's say, I'm just going to do it for the 1 year proration. Let's say it's sold in June of the year. So again, the annual tax is based on $1 million, but the negative supplemental would be about $3,750. So the property owner will get a bill for annual taxes based on $1 million. And so $1 million at 1.25% times 0.0125 is $12,005. So they have to pay that. But they will then get a check, and sometimes they'll get a check for the difference before they even have to owe the annual bill. So they'll get a check for about $3,750. So in the end, when you net it out, it would be close to what they would have been paying based on the $700,000. And the supplemental estimator would be able to provide that information when you put in the numbers. But that is something that we saw quite a bit of during the Great Recession, and that was around 2010, 2011. We're seeing a lot of that.
Awesome. Thank you so much. So I have a question here. Is there a proposition covering a blended assessment? And the example they gave is Prop 13 and 60 to cover if replacement property is assessed for more than the primary property. The situation's also a sale between a child and a parent, and I read the blended was proposed in 2017.
You know, I don't know enough about that to answer it. I'm not even clear what they mean.
I do think that there are some, I mean, it's difficult because on the Q&A, all I can really read is what people actually type in themselves. But what I think is for all of these, because we do have some questions that are more specific to individual situation. So I think the best thing to do would be for them to reach out to you directly. That way you can get as much information as possible. So with that being said, I want to plug to everybody because I don't want you to think we're not answering your question. I just, you know, it's best if you get a personalized answer. So again, Carol's contact information is, her phone number is 213-974-3101. And her email is cquan@assessor.lacounty.gov. So if we do skip over your personal questions, please reach out to her directly. She's more than happy to help you. Did I give your correct information, Carol?
Yes, you did. Thank you.
Okay, perfect. Of course.
So, going back to some of these more general questions, we have another one here. If a child fails to give notice and there's a supplemental bill, but they could have qualified for a 58 exclusions, can they retroactively file for Prop 58 exclusion?
So they can still file as long if they're, let me think, situation by situation. If they're still within the 3 years and they haven't sold the property yet, so we're within the 3 years, you haven't sold the property, we haven't sent you a notice of supplemental assessment, you can go ahead and file. Or let's say you recorded an affidavit of death, but you never notified us. And so we reassess the property. As long as you file within the 3 years, or let's say it's already past 3 years, but then you got that notice supplemental assessment because let's say you did a refinance or something on the property, then you would still have 6 months from the mailing date of the notice, a supplemental assessment or escape assessment to file. So you do have a little bit of grace period, but it's a very narrow window. And so if you meet those filing deadlines, it can be retroactive. So again, as long as you're within 6 months of the mailing date of the notice, a supplemental or escape assessment, paperwork has to be in-house, not in transit on the last day. And you make sure it's in-house. We have a copy of the trust, we have the claim form, it's properly signed and executed, then, it's considered, I guess, timely. So we could treat it as timely and make it retroactive if it's approved. But if you file late, you can still get the benefit as long as you haven't sold it to a third party, but it would be prospective relief only.
Okay, thank you. And then this one's kind of a long one. So if a divorced parent who owns a property remarries and then passes away, will the property be left for the children or the current husband or both? What can it be done to make sure it goes to the children only?
That's an estate planning question.
Yeah, that's I just heard that one.
That's a good question, but that's something that the parents, they should work with an estate attorney when they go through a divorce. That's something they need to work with their divorce attorneys as well, but that's an estate planning question. And I'm sure it can probably be dealt with in the parents' trust or in their will.
Absolutely. And I just want to throw in there now too, our next Wake Up YPN is actually a document preparer, and she is going to be able to answer a lot of estate planning questions. So if you have any estate planning questions, please tune in to that next YPN. I'm not sure of the date at the moment, but we'll make sure that we let you know. Next question is, does the property get reassessed if only one of the two people on title pass away? Must the death of one of the owners be reported and this is not in a trust?
Okay, so whether or not a property is in a trust, if one passes away, we should be notified. If it's a husband and wife situation, then the surviving spouse won't be reassessed. The surviving spouse would be excluded under the interspousal exclusion. If they're not husband and wife, then if they are registered domestic partners, then that would be excluded as well, as long as there's a surviving person there. But we still would like to be notified so that we can update our ownership records.
Got it. Okay, so now we are kind of getting into the Prop 6090 section when you were discussing. So it says on Prop 6090, if the replacement property is higher than the original, is the new replacement completely disqualified?
Yes.
Got it. And then another question was asked quite a couple times. So you said that with Prop 6090, it can only be one time only. Is this per spouse, or is it like one time per household?
It's one time, and husband and wife are deemed to have used it together.
Okay,
It's a once in a lifetime benefit.
understood. And so for that, do both owners have to be over 55 in order to use it, or just one owner?
Just the claimant needs to be 55 years or older at the time the original is sold, and the claimant must be the one filing.
Got it.
There's another one here that says, is the property reassessed after a PACE/HERO loan has been paid off?
No. So the PACE loan is separate. Now the work that caused the PACE loan to be generated, depending on what kind of work was done on the property, we may assess for new construction. If it was added square footage, we would reassess for additional square footage. But typically, these PACE loans tend to be more like home improvement, replacing some windows, a new roof. And so for roof replacements or like-for-like replacements, we typically don't reassess for that.
Okay, awesome. Sorry, I'm going through some of these questions here. It says if your home is in a county that is not one of these 10 counties, I'm not sure what 10 counties, but can one purchase into one of these 10 counties and use Prop 6090?
So let's say your home is in let me see, where can it be? As long as, it doesn't matter where you are in California, if you purchase a replacement home in any of the 10 counties that have an active Prop 90 ordinance in place, they will take that trended base from any county. Does that answer the question, or maybe I misunderstood?
Yeah, I think that was a good answer. Thank you so much.
Another one is for Prop 6090, so you have to be 55 years in order for it to work for you. So is that based on the sale of your home or the purchase of your replacement home? Do you have to be 55 or over?
At the sale of the original.
Got it. Thank you very much. That was an easy one.
Yeah. So if you're not 55, you might want to consider waiting before you record that document.
Absolutely. What process do homeowners follow if a spouse dies when the home is placed in a trust, and is there a change of ownership statement?
So there is that change of ownership statement as a property owner, and then another document that some people may file is also the recording the affidavit death of trustee, but that's just to, again, update ownership records. If there is a surviving spouse, then there is no reassessment. And usually when you record the affidavit of death, I believe you also include what we call the preliminary change of ownership report. And then even on the COS, death of real property owner, there are certain boxes that you would check so that we know that there is a surviving spouse in there.
All right. If you record a lease on a commercial or vacant land property, can that trigger a tax assessment?
It could. Typically, leases that are 35 years or more will trigger a reassessment.
All right. Another one we have here is there a full reassessment if a property adds square footage to make a bedroom or a living room larger?
It is not a full reassessment of the entire property. We will only assess for the additional square footage that was added.
Okay. If one has claimed the 55 plus exemption and then does improvements to the house, how will the improvements affect the tax or the assessment?
So let's say they've done 60/90. We've transferred the trended base. maybe a couple years later, they decide to do improvements on their home. Again, we will only assess for the additional square footage added or for whatever improvements are made. The base value that was transferred over stays the same. So we're only picking up the new work that's being done and adding it to the existing base.
Got it. Awesome. Okay, let's keep going through these. What benefits do young adults have when they purchase a property? Are there any laws that protect us from paying high property taxes?
The only thing out there for homeowners is just the homeowner's exemption. And if property owners do not agree with their assessed value, because property taxes are based on the assessed value, they can file a formal appeal with the Assessment Appeals Board. And the filing period with the Assessment Appeals Board is July 2nd through November 30th. And that's, again, if they bought a property, a couple years go by, they don't agree with their assessment. Let's say they believe there's a decline in value. In addition to the informal filing with the assessor's office, they can also file a formal appeal for a decline in value with the Assessment Appeals Board. Okay, wonderful.
Awesome.
Go ahead, Cyrus.
Yeah, if property is in a trust, do you still need to file? Do you still need to file for parent-child exclusion within 150 days, or just notify county of death property owner within 150 days to prevent reassessment?
We want to be notified within 150 days, but if you're already notifying us, then include the parent-child exclusion form. Include everything in that one package. I had that one slide where it said documents to send to the assessor's office. So when you're notifying us of the death of the parents, let's say both parents are now deceased and the child is the owner now, they're the beneficiaries. When they notify us by filing that change in ownership statement, they should also include with that COS the death certificate, the trust agreement, and the parent-child exclusion form. Because what will happen is that when they notify us and we look at the trust and go, well, okay, we're notified, is there a change in ownership? And then we're going to send notices, and if the child doesn't respond to the notices, then we're going to say, well, based on this information, we're going to reassess the property. So if you're going to notify us and you qualify for a parent-child, or you're eligible for a parent-child, go ahead and submit all that documentation in one package to our office.
Awesome. Thank you. And then I have a question here. How are property taxes assessed if you acquire a property from a distressed seller or someone that needs to sell quickly, and you acquire property at much lower than market value? Would it still be based on purchase price?
The answer is no. The law requires that the assessor enroll the value based on the fair market value. And so in a foreclosure distress sale, let's say you paid $500,000, but the market was really $1 million. We will enroll the $1 million. And if the property owner does not agree, again, they would actually have 60 days from the mailing date of the supplemental bill or the notice of supplemental assessment, whichever is later, to file a formal appeal with the Assessment Appeals Board on the base value. And they can also contact and speak with our appraisal staff to say, hey, this $500,000, yes, it was a foreclosure, but X, Y, and Z, which is why it should be $500,000 should be the base. So they can argue, but we can agree to disagree, and they would still have some time to file the formal appeal with the Assessment Appeals Board.
How are ADUs currently being assessed?
We basically treat it like any other new construction. With the regular ADUs, we, on our records, we might create what we call a separate subpart, but we don't include the square footage of the ADU with the square footage of the main residence. So we still assess an ADU. If they build it, we still go with our normal approaches to value in valuing that ADU.
And so in order to file for 6090, is it at the time of the transaction or is it at the tax filing time? And is there a form and is there an easy way for them to find it?
With Prop 6090, they can file after they acquire the replacement. So they sell the original, they buy the replacement. They have 3 years from when they acquire a replacement property to file for the base value transfer. The form is available on our website, assessor.lacounty.gov. But on the preliminary change of ownership report, there is a box that if they check that says this property is acquired as a replacement for persons 55 or older, if they check yes on that, then our ownership division, when they see that, they will automatically send out a claim form as well. But if they don't want to wait for us to send the claim form, they can go ahead and download it from our website, fill it out, and send it in.
Awesome. When you transfer a home into a trust that's a revocable land trust, is there a new tax assessment?
So let's say Carol transfers to Carol's revocable living trust.
Yeah.
There's typically no reassessment there. But sometimes what will happen is that, let's say Carol transfers to the ABC Trust. The assessor doesn't know that ABC Trust and Carol are the same. So we will send out a notice or a letter saying, can you please provide us a copy of your trust? If you receive that request from our office, please respond and provide the requested documentation. Otherwise, we will reassess it 100%.
All right, in a room addition, is there a minimum square footage for the property not to be reassessed?
No. I mean, even if you add 10 square feet, we would assess for the additional 10 square feet. So there's no particular minimum when you're doing a room add, no.
I'm not sure if this is a question that you would answer, but someone asked, the square footage of a condo is different in the assessor's record than the builder's. Do you know any reason why that would be?
Well, the condo square footage, we base it on airspace maps. So it depends on the airspace information that is provided to our office by the developers. So I wouldn't know why there would be a difference between the airspace maps that have been submitted to the assessor's office versus what the developer would have. So
okay,
that's
so then
a good question,
you know where someone could find the correct answer for that? Should they go to the builder, or is that something, what do you think?
Well, they can submit a property data change request form, and that form is available on our website, assessor.lacounty.gov. And then they should also contact their developer and say, hey, you know, your square footage is this, but the assessor's airspace maps show this. And, you know, when you go to our website, you can pull up the property profile and you can look at the assessor map. And with condos, you can look at the airspace maps that we base the square footage of condos on.
Great. And then
Awesome.
Another question we have here is, would an ADU addition change the type of property from a single family to a duplex, for example?
No. We would not change the use code from a single family from our use code for single family is 0100. So because you add an ADU, it will not change it to an 0200. No.
Awesome. That's good to know. And then are all assessors forms in each county the same?
If they are state prescribed forms and they are the same, they might just have different headings because it would have the information for that particular county. But certain forms are standard. If these are state prescribed forms, if these are BOE forms, then they're all standard.
Awesome. That's great. So actually, Carol, that was it for our questions. What I did want to say is, can you maybe repeat your contact info one more time just for anybody that wanted to hear it? And then, yeah.
Okay, so my email is cquan, at assessor.lacounty.gov, and my phone number is 213-974-3101.
Thank you so much for answering everything for us, Carol. We super appreciate you coming on. And I also just want to let everyone know that YPN thanks you for being a part of this today. Please go to PWR and you can check out the calendar, see all of our upcoming events. We're trying to do as much virtual meetings and conferences like this as possible, just so that we can keep on educating all of our wonderful PWR members. And anything else you want to plug in, Cyrus, before we log off?
And if you guys haven't already, actually, Danielle and I have a podcast called Hustle and Motivate, and it's all things real estate and whatnot. So you'll find that at podcast.pwr.net. We invite you guys to tune in. We just released a new episode, and we'll be releasing them, bi-weekly.
Yeah, we would love to have you tune in. That would be so great.